Let's start with your understanding of the setup, because we've seen not a meltdown, but we've seen a very strong reversal in tech stocks. Select FANG stocks are getting smoked, and India also, the tech space, which in a sense you've heavily invested in, after months of outperformance seems to be hitting a pause button.
I think one has to look at the meltdown in two parts. There are stocks which are down anywhere between 40, 50, 60% from the highs that we saw in the tech space. And there are the FANG names, especially Facebook has seen a sell-off. But broadly, if you see the results of, let's say, Alphabet, which is Google, or Microsoft or Amazon, people have been pretty happy with it, and they are maybe down 20% from the highs, which is more or less a normal kind of thing, up and down kind of scenario. I think given that money is becoming more expensive relatively as compared to where we were, European bond yields have gone into positive territory, inflation is high. This era of free money and just founders selling a vision to investors, saying, oh, we'll run losses for 5 years, 10 years, and we will get profits after a decade, but right now we are chasing market share. I think that kind of storytelling is over. People are clearly not willing to bet too much in the future, and which is also the story of a sell-off in probably something like a Facebook, where the core is not so much of a problem. Okay, user growth has tapered off in the developed countries, marginal dip in user growth. Mainly it's the big bet on the metaverse that they're doing, and people are questioning, meaning will that pay off or will that succeed or not. So that apart, basically, I think the focus is coming back on cash flows, on earnings. Just chasing a vision or storytelling is past. I think we are going into a dot-com bust kind of thing after almost 22 years, where there will be a segregation. People who can really deliver good business sense versus people who just are burning cash and they will flame out.
Let's talk about what the total capex is that the company has slated, and how much of the capex is going to go towards businesses other than that of refining and marketing of oil.
So we have got around 14,500 crore capex for this year, and in the time to come next year also it will be in the same range. Now, as you are aware, that in the past our major capex was towards the refining, petrochemicals and gas business, and those projects are slowly getting completed. And we are moving our capex profile more towards the newer parts of energy, the renewable and EVs, and and the non-fuel retail as well, and some part to even green hydrogen. And we expect that around 20 to 30% of our capex will go to non-traditional areas of business, which is basically continued to be transportation fuel in the past. And so we expect around 30% of our total capex will move towards chemicals, towards LNG, towards non-fossil sources of energy, EVs, the green renewables, etc.
So congratulations on the IPO. Could you just talk about the demand trends? What has been the growth? How would you look forward going ahead?
See, at Adani Wilmar, we are continuously looking and studying the demand from the consumer side, both urban and rural. Now, we'll have to divide this into two parts. One is the edible oil. This is a very matured category, and consumption are almost steadily growing at around 6 to 7% per annum, and that is how we have been growing, little better than that. And it will continue to do like that only in days to come. But the major play or the major opportunities that we as an Adani Wilmar sees is in the branded staples category. Now this branded staples category, actually if you see, is hardly 10 to 12% branded, unlike edible oil, which is 80% branded. So going ahead, a lot of consumers are now shifting to packed staples. They need more hygienic products, they need healthier products, and e-commerce has added to the ordering on the grocery. So we have been growing at around 25 to 30%, and we hope to continue at these levels.